morning, everyone. Welcome to the Roots to Results webinar series hosted by Manitoba Crop Alliance. My name is Ashley Amater. I'm going to be your facilitator for today's session. We're so glad to have you all join us this morning. This is the first of a five webinar series exploring farm business management topics that can drive measurable outcomes for your farm. Before we get started with the main presentation, a few quick housekeeping notes. First, today's session will last about 60 minutes, including a few minutes for Q&A at the end. Please feel free to submit questions anytime using the Q&A feature. We'll gather all of those questions up and address as many as we can at the end of the presentation. In addition, this session is going to be recorded and will be available later on our YouTube channel. Manitoba Crop Alliance will be producing some wrap-up articles that will also be featured in our monthly e-newsletter, summarizing key takeaways. So at this point, it's now my pleasure to introduce today's speaker, Chuck Penner with LeftField Commodity Research. Chuck founded LeftField Commodity Research in 2010. He spent nearly 30 years working in the grain industry, including 5 years as a senior consultant in the Canadian Office of Informa Economics, 1 year as the Director of Marketing Strategy for Black Sheep Strategy, and 15 years in various roles with United Grain Growers and Agricorp United. Penner has an agribusiness diploma and a Bachelor of Science degree in Agricultural Economics from the University of Manitoba. He also has a diploma in Biblical Studies from the Winkler Bible Institute. So we're really thrilled to have Chuck with us today to share insights on using market and historical data to shape your grain marketing plan. And with that, I will hand things over to Chuck.
Well, thank you very much, Ashley. I just realized as you were doing the intro that I've been doing LeftField as long as I worked at UGG. So that's quite something. And when they say, "Oh, you have 30 years experience," well, that makes me feel really old. But maybe the better word is to say experienced. So I've been working in this for a few years now, of course, as you heard, and a lot of that time we've been talking about seasonal price behavior and all of the data. I was told at one point that data is the most important part of your business, and that certainly is true. And so over the last few years, I've been doing more and more exercises or more and more work in terms of figuring out how that data can be useful and have a payoff, actually, rather than just be interesting. So hopefully what I go through today will be that. So with that, I'm going to share my screen and make sure I hit the right screen because I have 3 screens in front of me. So can I just get Ashley, could you confirm that you're seeing the presentation?
Looks great.
Okay, good. All right then. So I call it planning without prediction. And so much of what often we see in market analysis and market strategy is trying to figure out where prices are going or predict where prices will be and things like that. But we think there's a lot of usefulness, utility in the data and what's happened in the past and using that to guide marketing plans. So as I've done presentations for many years, I've come across all kinds of different reactions, and some people just hate grain marketing and just avoid it like the plague. And then there's a whole range, and then there's a few people, and I think it's a pretty small minority that just love grain marketing. They just love reading all of the stuff and finding out all of that kind of information. But it's not everybody, and so this is geared toward probably the ones who, well, I guess the whole range, but the ones who want to simplify it, not want to have to spend tons of time working at it. But in terms of the effort versus the impact, I know it's not most people's favorite thing to do, but I think it's the highest return for the lowest investment, dollars or time. So if you take an average farm size of 5,000 acres or so, and 40 bushels an acre, if you can gain 10 cents a bushel, and that I think is really doable. There's a gain of $20,000, and you go, okay, but what about 50 cents? Then you're looking at $100,000, and that goes straight to the bottom line. So is that worth a bit of time every week to go into that? So anyway. So I think we've got something that will help improve that those outcomes. There's all different kinds of ways to sell grain, to figure out how to market grain. And what are the triggers? And so, there's I'm not going to go through each one of these, but there's all of these different types of ways, and people generally, I think, use a mix of them. Some people try to have a price in mind, or this wishful thinking, or if canola can get to $16, that's my price, or whatever the price happens to be. There are people who use grain marketing advisors, and those are very helpful people. They can tailor stuff to the individual market situation. There's people who just market when they get a call from the grain buyer or a text. Okay, we got a special on. There we go. There's our sale, and so on. So, but there's all different kinds of ways to make decisions about marketing grain, and so we're going to look at a little bit different one. But these are the kind of questions that I get when I'm out doing market presentations. People will ask me, do you think the price will get to whatever the price happens to be? I remember quite a few years ago, I think it was 2016, somebody asked me, are we ever going to see $20 canola? And I said, sure. I said, I have no idea when the timeline is. And then, of course, we got to the 21-22 drought, and we got there and more. But people will say, especially when it's rallying, how high can prices go? Or when they're not high, or when they're not rallying, when are they going to turn higher? Or should I wait for this? And all of these require some sort of prediction about what prices are going to be in the future. And so that's a dicey uh, place to be. And people who know me know that I shy away from, I avoid trying to predict prices. And it's not because I'm a chicken. It's because it's very, very difficult. It's not a great marketing strategy. I mean, people talk about these black swan events and things like that. So this headline says, it's a couple of years old, but black swan events to watch for in 2024. Well, by definition, black swan events are not something you can watch for. Like, they're completely unpredictable. They're come out of the blue, or out of left field, if you will. Um, and people are terrible at predicting things. We still try, but we're terrible at predicting things. Sometimes we get it right. We guess right. But, there's people like Dennis Gartman, who's a famous market analyst, and he said a couple of years ago, a number of years ago, we won't see $44 crude oil in my lifetime. Well, he's still alive. And we've been there. There's another prediction here that, by 2030, demand for cow products, basically that the cattle industry is going to be bankrupt. Well, look at the situation over the last year or two, and they're doing pretty well. So, those kind of things. And you can even ask AI for predictions as well. And so, and I think that's becoming a more common, it's becoming more commonly available. I'm not going to comment on the accuracy of it, whether that's any better than natural intelligence. But anyway, so you can get all kinds of predictions. But as a farmer, uh, here's been my experience, is that it tends to be you like to look for the bullish predictions, not the bearish ones. And and so which ones are credible, and can actually anybody really rely or can really predict the future with any degree of consistency? So yeah, you might guess right once in a while or so on, but can you really predict the future with some sort of consistency? And so that's why I shy away from the whole prediction business. We do some forecasts. Don't get me wrong, but we try to make sure that people know that these are forecasts. Um, they're not certainties by any means. So, for example, if you look at canola, at the canola market, and these are not even all of the things. So if the question in the middle is, will canola be above $15 by November 1st, by next November? So what are all of the factors that go into it? Well, there's the Canadian crop. Well, what goes into the Canadian crop? Well, there's the acres. And what goes into the acres? Well, there's price drivers and what other crops are doing, and rotation things, all kinds of things that drive acreage. And then there's the yield. So those are the two main components. But what goes into the yield? Well, the rain. And then the rain, there's the amount of rain. And then there's the timing of the rain. And then there's disease, then there's temperatures. Well, what if they're too high? And what if you don't get enough heat units and all of those kind of things. So then you take that Canadian crop thing and then you expand that into other crops. So European rapeseed and South American soybeans and Ukrainian rapeseed, and all of those have all of those same sort of factors. There's all of the financial stuff, crude oil prices and what the funds are doing with their trade positions and all of those kind of things. There's increasingly the policy thing. So anything to do with Chinese trade disruptions or the clean Canadian fuel standard or US biofuel policy, all of those kind of things. So if you're trying to predict if canola will be above $15 by November 1st, these are all of the things that you have to predict to be able to put together uh, and then you don't know, of course, well, how much of an impact is Chinese trade policy going to have on Canadian prices, or the number of degrees over days over 30 degrees in Western Canada? How much is that going to have? So I'm just trying to point out the difficulty of trying to make predictions. And that information is always changing. So I use this little example. Forgive my terrible graphic design skills. But it's like a Plinko game where, you start in March and, well, we're going to be looking at lower acres. So that's bullish. And you have a dry April. So that's even more bullish. Oh, but then you get some timely rain at the beginning of May, and that becomes more bearish again. But in the soy planting in the U.S. is having problems, so that becomes more bullish. And then, and all of these things, and so you don't know all of these factors all at the same time. They just kind of fall out as the year progresses. So, is it realistic to predict prices in November, December, back in March? So again, I just want to be realistic or clear-headed about how predictions can be made. So if price prediction is mostly guessing, there's of course, that famous saying that history doesn't repeat itself, but it often rhymes. And that we've been looking at this and testing this with respect to grain prices. So looking at patterns and precedents, how prices have moved over a bunch of years. How often does it happen? Is it regular or quite regular? It's never 100%. Are they going to apply this year? Why would it apply this year? Or maybe why not? And then, what are the odds of these things happening? So that's kind of what we've really been working on over the last while. I compare it actually to grain marketing with gambling to some degree. And I avoid the casinos because I kind of know myself. So I avoid the casinos. But in terms of grain marketing, there's a lot of parallels with gambling, I think. So there's a certain amount of chance in the market because you don't know what China is going to do or how the weather is going to play out in terms of, rainfall and temperatures and all of those kind of things. And can you control the cards that are coming up? No, you can't. Can you predict? Not really. You have to deal with what's in front of you. There's always the wishful thinking too, is hoping for an ace after you get a face card or something like that. But what separates the person who's good at gambling, because there are professional gamblers from novices like me? Well, it's the odds. Does it work 100% of the time? This little picture here shows the strategy card for playing blackjack, and it's based on the odds. So if you get a certain card, if you have a certain certain cards in front of you, and the dealer has certain cards, has a certain card up, what are the odds? And so what should you do? And that's how these blackjack players who are successful work, is they think in terms of odds. So that's what we want to do, is improve those chances of success. So we think there's a way to use the data to increase the odds of success, not 100% guaranteed, but also to add more structure and discipline. So again, rather than some of those other marketing approaches, how can we add some more discipline to that and take out some of the emotion? Because there's lots of it. I get it. I understand that people's livelihoods are on the line. And also increase some confidence, be a little more secure in making the decisions. So those are what we want to try and do. So some of the benefits of that, it takes out what I call motivated reasoning, which means you process the information that's in front of you to get a certain conclusion. Um, it also helps avoid what I call market amnesia. So forgetting when prices have been at certain levels, or how high or how low they've been, and it's based on actual events. So this isn't a wishful thinking or that sort of thing. It is backward looking. So it's based on what has happened. And if we learned anything in 21, 22, it was that the precedents kind of got blown out of the water. And so we had to rethink things. And it works best in the non-extreme market situations. So again, not 100% guaranteed, but certainly useful and powerful. So one of the central concept is something called reversion to the mean, or some people call it regression to the mean. Um, the more common way of saying it is the best cure for high prices is high prices, or conversely, low prices is low prices, and that is that supply and demand try to find an equilibrium, and they never really get there. Like they're always kind of going past this equilibrium, but they're always trying to do this, and it causes cycles in markets. So highs and lows, and so you can see that trying to happen. What that also, the other part that we focus on a lot is the seasonality, and so this is fairly consistent behavior by both buyers and sellers that causes patterns, repeatable patterns through the year. So that's what we're going to be focusing on a lot. So we do this seasonal index. We create these seasonal indexes, and we've created them for basically all of the crops, special crops, pulses, oil seeds, grains in Western Canada. Um, and so when are the seasonal highs and when are the lows? Is there more than one high? Because sometimes there's a primary high and a secondary high, and so on. So is there more than one? But it shows the average of behavior over time. So some years the prices move a lot more extremely than the index, a lot of times less. And some years they don't follow the seasonal index. And that in itself is a really important market signal. And they work best without situations like market interference. Like again, we have some of those cases this year in canola and in peas, and so on. So that's what we do. It doesn't show the size of the move; it shows the timing and the direction. Um, and so I'm not going to talk about how we calculate them. That's a whole boring other topic. But we also we also show it in a little different way, usually showing monthly average prices. So it's just another way of looking at it. So we're going to look at that in a number of ways. So we're going to do a case study for red spring wheat. That's what we're going to do in today's webinar, is look at the seasonal prices, and we're going for CWRS wheat, and we're going to look at this index and then these monthly average prices. We also did a thought experiment that is looking at um, how prices respond after harvest. And this became more important to me in the last few years, where around harvest time, we'd be getting feedback from people in the country, from farmers and others in the country, and advisors and so on. And they'd be saying, well, grain buyers are telling us we should be selling now in around harvest because it's just going to keep going lower. So we thought, wait a minute, there there's there's um, is that true? Or how often does that happen? Is that a so anyway, so we've done a thought experiment with respect to that. We did another thought experiment, and I'll explain it when we get to it. But it's how um, prices, or how prices look if you would sell. Yeah, I'll explain it when we get there. I mean, put it that way. But it compares the seasonal sales strategy against a couple of benchmarks. And then also in terms of short-term price direction. So some of this is like over the year, that kind of thing. But what about in the next few weeks? How will seasonals drive or determine price direction? If prices follow the seasonals, how is that going to look over the next few weeks? And then if someone challenged us, he said, well, what about new crop pricing? Our new crop bids forward contract bids, are those seasonal as well too? So we did some work there as well. And then we also did a bit of a comparison because again, I get these thoughts in my head and I kind of go, is it better to forward price? Is it better to price it just in the spot market? Um, and so again, thought experiment. So let's use the data to see whether that would have worked or not. And then some other indicators, and so on. So all that intro being said, this is a seasonal price index for red spring wheat. So the black dashed line there shows this seasonal index. So this is prices over the last, well, I guess ever since the open market in red spring wheat. And so what it shows is a fairly distinct seasonal index with two highs. So, well, first of all, there's the low in at harvest time, and this applies to every crop. When prices drop during the summer, and people are panicking and going, "Oh no, it's the market is falling apart," and well, no, it's doing what it always does. So that's part of the reassuring thing that comes out of seasonal indexes. Um, but there are two highs. There's a secondary high that happens in November. So after harvest, prices rally, and then there's a primary high that occurs in generally around mid-May. And so that's how prices tend to move when you aggregate all of these years together. But you also see, so 2024 is shown with the blue line, and it followed the seasonal index quite well. And part of, well, and then of course you have 2025 where it's also followed that, and it is starting to move higher. Part of the issue with 2025 is we've grown a really big wheat crop, but it is still recovering off the lows. And so, again, it's still, even in spite of that, it's still showing that. But in a large crop, a year with a large crop, it's not going to move as sharply as it does in other years. So again, this tells you the timing and some of the direction, but it doesn't tell you how much it's going to respond. So again, it's got its benefits, and it does have its limitations. So that's the seasonal index. So that is kind of the the framework or the undergirding or whatever you want to call it for this whole discussion about seasonality and how it can be used. When we to look at it another way, we just took again over all of those years, over the last 9 years, we looked at average, or we looked at spring wheat prices in each of the various months. So again, you see that there are two distinct highs in the market, in one in November and then an even higher one in May. So, if you think in terms of when should you be selling your spring wheat, well, certainly not in September. Um, if you need to sell some in fall, there's November. If you can wait until till the next or till the next calendar year, May is going to be your best choice. And so again, this is what happens over a bunch of years. So it's the average response. It's the typical response, if you will, in terms of red spring wheat prices. So then, as I said, we did this thought experiment, and it's how prices respond after harvest. So every summer, there's this doom and gloom that I call it, where prices are declining and people get really weighed down, and all of the news becomes negative. But that's what happens to prices every single summer. Even in 21, 22, when we had the drought, prices were starting to drop early in the summer. And then when we saw, well, of course, the drought is irreversible. It's like not going to come back. The crop's not going to come back. Well, then prices started to move. So they turned higher sooner and more extreme, but they still earlier in the summer they were ticking lower. So the question is, what usually happens after harvest? And there are some of these pressure tactics. I heard some again this year. Well, you better get your wheat priced now because we may not be moving it. You may not be, otherwise you may not be able to move it by the time by December. Those kind of things. So the question is, from the seasonal low, how often do prices go up, or do they sometimes go down, and by how much? So this is I'll walk you through this table. here. So what this table shows, and there's a lot of information on here. So it shows the last from 2016 to 2024. And in the top line, it shows the seasonal low. So in that month, in September, where were prices? And then by the end of October, we did three or four different time frames. At the end of October, at the end of November, and at the end of December, and then also in the month of the seasonal high, which, as you can see at the bottom of the table, that's mid-May. So we looked at prices in mid-May. So by the end of October, if we just look at that one, um, in those 9 years, every one of those 9 years, prices were higher by the end of October. And you kind of go, okay, well, that makes sense. That's it's called a seasonal low for a reason. So it should be higher than that. But again, there's always this niggling feeling like, "Ooh, what if it doesn't respond? What if it just keeps going lower?" Well, not going to say it can never happen, but in 9 of the last 9 years, it's been higher by the end of October. And you can see the range of how much it's been up, as high as $1.97 a bushel. That was in 2021. Of course, that's the extreme year. And the lowest was 2018 when it was only up 22 cents from the seasonal low. But on average, over the last 9 years, there's 83 cents a bushel, or 11% higher by the end of October. To me, that's significant. 83 cents a bushel is pretty significant. And we haven't done run 2025 yet. So I can't say it's probably going to be on the lower end of that, but prices were up. And then even you look at end of November, end of December, the increase in prices from the seasonal low is about the same. So there isn't a big advantage, waiting for the end of November or the end of December. But then if you look at the last section there, this seasonal high, the average difference from the seasonal low is $1.31 a bushel. And that happened, there were gains in 9 of 9 years. Some very small, 3 cents in 2018. So that doesn't even cover your cost of your expenses and interest and those kind of things. So I get that, but there were some that were quite a bit more significant. And so again, it's uh, when you look at the odds, 8 or 9 years out of 9 years, those are some pretty good odds of a strategy of waiting at least till the end of October, and then maybe waiting until the seasonal high with some other with some other sales. So that was one thought experiment that we did. Here's another one. And this one was kind of fun, and I found it fun because I love working in spreadsheets. That's my jam. But what if a person sold everything during the week of the seasonal high? So not try to find the high price and then like go look back and say, hey, well, there was the high price. Let's compare that. But it's in that week of the just go back a slide here. The seasonal high for wheat was mid-May. So what if every year in mid-May you sold all of your wheat, um, and then compare that against a couple of different you know, uh, benchmark kind of thing. So what if you sold 1/12 every month? So equal amounts every month. So you had 1,200 tons, you sell 100 tons every month. Compare it with that. Or what if you sold it in kind of 4 sales periods when cash flow needs are, heavier? So end of October, end of December, end of March, and end of June. And how often would that, how would those sales strategies compare? And what would that mean in terms of the price you would receive for your wheat? So it's a thought experiment. Nobody sells their stuff in 12 monthly increments or, exactly these 4 time frames, but we had to have some sort of reference. So that's what we'd used a couple of different things. So this goes back to 2013 and then to the last year. So in the first column there is this seasonal. So if you sell 100% in May for red spring wheat, what would be the price you would have gotten? Then the middle one is equal sales. So you sell 1/12 every month. And then the third one is kind of this cash flow sales, October, December, March, June. And so in each of those years, which strategy would have gotten you the highest price? Well, in 9 out of the what do we got? 12 years there. 9 out of 12 years, selling it in that week of May would have gotten you the highest price 9 times out of 12. And twice it would have gotten you the worst price. And once it would have gotten you kind of the middle of the road kind of price. So again, when you think in terms of odds, and I'm not advising that you do this, sell it all in 1 week of the year. I'm not. I understand there's realities that play out here, um, but this is a thought experiment. So again, does it pay? The odds would say that yes, it does pay to at least wait with to shade your sales or to shift some bunch of sales to that month of the seasonal high. And so that's the example that we have for red spring wheat. Other crops, it isn't as consistent, and I'll grant that. It's not. It's there are some where it's even a little bit more yet, but other ones where it's not as consistent. So, fair game. And so we've done this for all of the different crops. This is a case study in terms of red spring wheat. In terms of short-term direction, so this looks kind of, we look at, excuse me, the whole annual sales cycle. But if you think about that seasonal index that I showed you, the dot dashed line that showed the low in September and the secondary high in November and the primary high in May, what depending on where you are in the year, how will that affect prices? So this is another thing that we've worked out. So it starts with prices currently, and I think this was last week's, and this is a prairie-wide average red spring wheat bid. So it's just on the left there, it's 705 a bushel is the current thing. Right now, the seasonals aren't showing much movement at all, and in fact, again, we have this high in in November, a secondary high in November. And then when you get 4 weeks later, you see across the bottom, it shows, how many weeks from the current date. So 4 weeks from the current date, actually, if prices follow the seasonal index, they'd be down actually a nickel. Whatever. That's neither here nor there. And even 8 weeks out, only a small gain, and even 12 weeks out. So right now, the seasonals are largely flat. So this is trying to look at, from a short-term perspective, are there situations where, where it pays to even wait a few weeks to make a sale, assuming that they're going to follow the seasonal index. The blue line there is kind of, at this time of year, what's the most extreme movement that we've ever seen? And even there, it's not a huge gain. And in the bottom is the yellow is kind of what's the worst we've ever seen at this time of year. And so, you got the average in red, and then the extreme high in blue, and then the extreme low in yellow. And even then, the extremes are, yeah, there's some declines and some gains, but for the most part, except for the 12 weeks out and I don't recall what year that was. Again, it might have been 21, 22. That's where we saw almost $1 a bushel gain. But on average, not much movement at this time of year. So, it's almost indifferent whether you sell now or sell 4 weeks from now, 8 weeks, 12 weeks from now, kind of thing. Here's another seasonal influence, and I have to throw this one in just because I found it just fascinating. This is rail freight from different corridors. So the blue is Manitoba to Thunder Bay. The purple is Saskatchewan to Vancouver, and then there's other Thunder Bay from Saskatchewan. Anyway, but what it shows is this is over the last several years, and these are from the Quorum Corporation. They track all of this stuff, and so what you can see is that pretty consistently the last 1, 2, 3 years, and well, now the fourth year, is that rail freight rises in the fall. So, I mean, we've even had grain buyers tell us, they're warning farmers, oh, great freight prices are going to go up. So that means your return, your basis, or your cash price is going to go down. But then what happens in spring and I think this has to do with the freight cap calculations, from what I can suppose, is that in spring, once they're closer to their freight cap, they start dropping their rail freight. So the difference, like in the Manitoba ones, it's not quite as extreme, but there's a difference of, depending where you are, like $12 to $20 a ton variation from that low to the high. So again, just waiting until the spring can help you just from a freight perspective in terms of your basis or in terms of whatever. So I find that interesting, put it that way. Um, and just something good to know. So that's why we're passing it along. People asked us about new crop seasonals. So this shows these are the last 6 years. That's how much data we have for new crop bids. Um, and so it shows the new crop bid in the light blue, and then the old crop bid in the like the spot bid in the dark blue. Um, so what it shows is that they kind of move in the same direction, but the spread is wider earlier in the year. Um, so I find that interesting as the markets converge. But it's also what we did then was we just kind of calculated these new crop average new crop bids over the weeks of when you might be pricing your new crop production. So forward contracting. So from the beginning of January till the end of June. Yeah. And what it shows is that over time, over these 6 years that we have, the three lowest weeks are in January. So, and then the three highest weeks are in May and June. Um, and again, that's the average of the last 6 years. But when we ran this for all of the different crops, we saw that quite consistent, very consistently actually, is that for most crops, January is the worst time to be forward contracting, and May, June is probably your best time to be forward contracting. So being patient in terms of forward contracting can also be very profitable, put it that way. Again, it doesn't work every year. There can be a trade thing thrown in there so all kinds of things that can happen. But this is what the data, what the history is showing us, that these are the best times and the worst times to be forward contracting your crop. So anyway, so that, and it ties in a little bit with it ties in with the regular seasonality, but it's also that spread gets narrower as you get later into the summer and so on. That spread between spot prices and forward contract prices. Um, so what we did was this one was a little bit controversial. I'm going to have to keep moving along here. A little bit controversial. So what we looked at was three different kind of scenarios. So one is if you forward priced everything in December and in March and in June. So those 3 points, you forward priced everything. And then what would happen if you priced it only during the growing year or in the marketing year, I should say. So after harvest, October, December, March, and then the next June. And then what if you split some? And so you forward priced fifth of the crop in June, and then the rest of it in the marketing year in those 4 periods. And so this one wasn't as clear cut, but what we had was the pricing spot, and again, for other crops, it's actually a little more consistent, but spot selling, like in the marketing year, tends to be to give you better returns, but certainly not the case. So we wanted to show this to you to just say, it's a mixed bag, put it that way. But there are some years, like in a year where prices are rallying, like 2021 and 21-22, those were both some really strong market years. Of course, we know that forward pricing doesn't turn out well. And so, can you predict those ahead of time, what those are going to be? Some cases you can see prices trending in a certain direction already. And then I would suggest that forward pricing in those kind of environments is not your best option. But spot selling is a better option. So when there's other things that we do and other things that we measure, so perspective is important. So if I ask you what's the average week CWRS price, and you kind of, well, based on what, right? How long and over? What's a good price? Is the current price good or not? People talk about selling in the top third. Well, what is the top third? And where are we now? And it also shows you the odds of a change in direction. Remember, I talked about that reversion to the mean. So if we look at this is 10 years worth of CWRS bids, and right now, the last time I ran this, we were at a little over $7, or right around $7, and so we're right kind of in the lower part of the middle third. But it shows what's the minimum that we've ever had over the last 10 years, the maximum? What's the average? The average is closer to $8, but not quite there. The top third is at $8. So if you want to wait till the top third, and if you can wait, if the market gives you that, that's that top third, that magic top third that we talk about. So if we're at the lows, that means there's more likely a chance of prices moving higher. There's more upside reward than there is more risk of um, downside in the market. We also do this thing called percentiles. So it's the frequency or maybe the odds of various price levels. So this will look at since 2015, how often has wheat been over $8? Well, it's been over $8 35% of the time. Over $10, only 19% of the time, and so on. So how realistic are price expectations? When we were at some extreme highs, people kept expecting them to go higher, but those odds get narrower and narrower and smaller and smaller. Um, so it doesn't predict where prices are going to be, but again, it's a sense of perspective. So where are we? This again, when we ran this was just under $7. So that was the case a little around about 50% of the time. And if you want to wait for $10 or even $8, the odds of that are smaller and smaller. But again, if you're at one extreme or the other, chances are it's going to move back toward the middle. And that's what the markets always try to do. We do this thing. I'm going to skip over this. It's just a summary for. We take a bunch of different indicators and we sum them up, and which crops are performing better than others. So this is what it looks like, but it's a bit of a long-winded explanation. So I'm not going to go into that. Um, but then here's the thing. And so when you boil all that down, I've done the case study for wheat. If you look at a typical farm, whatever a typical farm is, and then you look at three sales approaches, like I showed before, selling 100% in the month of the seasonal high. So for each of the crops has a different, well, some of them are the same, but each of the crop has its seasonal month of a seasonal high. So selling that crop in its seasonal high, again, we didn't go back and cherry pick the high price of the year. We just said that's the month, that's when we price, or selling it 1/12 each month, or those cash flow months. So what would the revenue result be? So here's the sample farm. So it has 200 tons of yellow peas, some flax, red spring wheat, some oats, canola, soybeans, and some feed barley. So 4,500 tons in total. And then this table also shows the month that the seasonal high is. So again, that's when we price it. So the oats, we price it all in November. And again, this is a thought experiment. It's not telling you should only sell oats in November, but something to think about. Canola in May, soybeans in May. A lot of them are in May. A lot of the highs are in May. So here's what we've done. And again, this table requires a little bit of explanation. So over the last, we went back and if you had that crop mix every one of these, all of these years, and you sold it all in the month of its particular seasonal high, here's the revenue, the gross revenue that you would have. And so you can also see what 21, 22 did in terms of gross revenue. Of course, people didn't have that much of the crop to sell, regardless. So this compares, that's the revenue for that. And then the column, it's 12-month equal sales. And then the difference between those two. So the totals for the selling only in the seasonal high and selling it 1/12 equally. And so you can see that over the last over 9 years, that is, how much dollar difference that would be if you just sold in the seasonal high month versus selling it all equally. And so you can see that there's a couple of years where it didn't pay off to sell it in the monthly high, 18, 19 and 22, 23. But the other 7 years, yes, it did. And on average, is $100,000 difference. And over the 9 years, if you add that up, it's $900,000 difference. And then there's the percent column in green there. So the percent difference between one approach versus the other approach. And then the cash flow sales, that's the October, December, March, June sales. So what the sales would be. And those are very close to almost indistinguishable from selling it 12 months equally. So again, then the dollar difference between the seasonal high approach and the cash flow, the 4 times a year sales. So again, it's not quite as large, but it averages $90,000 a year. And again, it doesn't work every year. And if you think about 22, 23, that's when we were coming off of the extreme highs of 21, 22. And so prices were working their way lower. So it was generally a year of declining prices. So being patient and waiting later in the year didn't pay off. So those are the kind of years where you want to watch out for and not use this seasonal high approach. 18, 19, we had the one of the Chinese trade disruptions on canola imports may have had a factor, but it was also a year where prices were generally declining. But either of these, like over the 9 years, your revenue would have been 5.8% or 5.2% different higher just selling in the high of the seasonal or selling in the month of the seasonal high. So again, not saying you have to do it like that's, but at least think about that as a factor in your selling decisions. So, positive over the long haul is just some summary kind of things. Positive over the long haul in most years, most effective in rally years, using that seasonal approach. Count doesn't help. It's bad, actually negative in years after extreme highs. And again, 18, 19 was a bit of a glitch. And 25, 26 is another one of those years. But so far, it's looking like could still pay off this year. But there's lots of unpredictable things to happen. So the seasonals, trust the market to behave normally. So when prices are declining in summer, don't freak out. Assume that they're going to turn higher most years after harvest. And then seeing all of this noise that you get and all that kind of stuff, avoid selling too much too soon. So some patience. And if they aren't following the seasonal pattern, kind of think in terms of, okay, now what does that mean? And what's causing that? So risk management is still needed. I'd say shade your strategy toward those odds. Don't bet everything on it. And these price highs or lows can be extended, things like the 21 drought or the 22 Ukraine war or things like that. And it's not how to trade day to day or things like that. And then, of course, the legal thing, past performance is no indicator of whatever. So there's that. And you still need to watch market events. So Indian tariffs on peas and Chinese tariffs on peas and on canola. And there's still room for gut instinct. So here's a little thing, this little meter that we put in there. We call them the market meters. It's kind of our gut instinct of whether things are going to be stronger or not. And there's no 100% odds, but we do, for in some of our reports anyway, we use these kind of, well, what are the odds of, prices in this range or that range? So we're not predicting where the price is going to go to, but here's where we think it's most likely going to be. And then, of course, the famous never trust absolutes. That's kind of ironic. So that's what we have. And just, I have to say, if you want more information about this, there's a couple of ways that you can do it. One is at Crop Connect. I'm going to be doing an extended version of this as a workshop there at Crop Connect. And then also on December 5th, just a few weeks from now, I'm going to be in Elm Creek. That's my old stomping grounds. I'm going to be in Elm Creek and doing a whole day workshop on that. So if you want to find more information about that, you can go to Crop Connect. You can go to our leftfieldcr.com website, and it will have that information there. So with that, I will stop sharing and turn it back to Ashley.
Well, thank you very much, Chuck. What an informative presentation. I have to admit that I'm among that category where marketing is kind of a scary black box. So I love digging into the data. So a reminder that folks are welcome to share any questions they may have in the Q&A box. While people are ruminating, a question that I had is you discussed some of these seasonal trends for CWRS. You mentioned that it's not necessarily as consistent for other crops. What would some of those crops be where the trends seasonally aren't necessarily as consistent?
Yeah, it's In some of the special crops, there have been certain patterns that can change. So, to take a little more obscure one, I'll talk about canary seed. Not many Manitoba canary seed growers anymore, but I'll throw it in there. Well, maybe I'll use flax. So flax has the pattern of exports, for example, in flax has shifted over time. So it used to be we would ship to China, Europe, and the US. Those were our three. Ever since 21, 22, our sales have been heavily focused on the US, not so much to China and not much to Europe as well, too. And so the reason that's important in terms of the seasonals is that when we used to ship to Europe, there was a slug of flax that would go through Thunder Bay in fall before the seaway would freeze up, and that changed the price pattern. So you'd get more strength in the fall, and then you'd also get another seasonal high in spring as they were building up inventories for a spring shipping program after the Seaway broke up, and so that would change things. And so the change in the trade patterns affects the seasonal behavior. So flax this year we're shipping to Europe again in fall. But it changes the pattern, and it's less predictable in terms of how whether prices are going to follow that. Are we going to ship to Europe or not? And that affects whether prices follow that historical index that's built over a whole bunch of years.
Okay, great. Thank you. Um, it also, you mentioned that there are some years, where prices are declining. I think you mentioned 22, 23 as an example, where this approach might not be as effective. Um, are there other things that can cause this approach to be less of a win?
Yeah. Well, we've seen it some pretty dramatic moves at times. If you think about peas, of course, this year it's got two headwinds now with Indian tariffs and Chinese tariffs on peas. And yet yellow pea prices are still kind of edging off the harvest lows, but I really don't expect there to be a meaningful kind of response. So that's why you still need some of the regular market analysis to go into, to give it some context around that. The same thing happened in 2017 when India dropped tariffs on or put tariffs on pea imports as well too, and the price just dropped. So that year, for example, so it's these largely these trade disruptions that are impossible to predict. But yeah, they certainly will make for a particular crop, make that seasonal or prices not behave normally or seasonally or whatever. So, those kind of things, you can see them. The one table that I showed about post-harvest price response, how prices move after the from the seasonal low, and so again, thinking about the pea example, 2017-18 was like consistently bad. So it was at the harvest lows, and then it got even lower because of that trade Indian tariffs on peas, and so it caused that to not work that year. So again, that's why I like to talk about it in terms of odds. Is that the odds are strongly in favor of following those seasonals, but it doesn't happen every year and not to every crop. Some years, again, but it's those kind of external shocks that tend to cause that. Otherwise, if you have roughly, you know, balanced supply and demand and those kind of things, it's going to do it. It's like never say never or don't always say always. But in those kind of years, the odds are even higher that it will follow those seasonal tendencies.
Okay, great. So when we see, because of a market shock or some other reason, that we're not following those seasonal trends, what would you suggest people do in that case? I notice it's not following seasonal trends. Maybe I know why, maybe I don't. What do I do next?
Well, then you fall back to maybe some of the other sales approaches. So, okay, is it profitable? Like, am I above my cost of production? So take some profits doing it that way. Or when the elevator does offer you a, extra 25 cents a bushel or, 20 cents a bushel, whatever, be more responsive to those kind of things. Pay a little bit more attention to those kind of things. Um, and here's the converse. So there's two ways that it could not follow the seasonals. One is, in the summer prices are always going down. What if markets are not going down? What if prices are not going down? And flax was again an example of that this year, where it didn't go down. It stayed higher longer than usual. Um, but the more that it does that, the steeper that drop off is going to be when it happens. But again, reward the market when it's giving you those kind of signals. And then if it's having a hard time, and flax is having a hard time recovering from those harvest lows this year, okay, well, there's a signal that I need to be maybe a little more defensive in my sales strategy. So thinking in terms of um, a little more be a little more aggressive with making sales again when they're profitable. If there's still 16 or $17 a bushel available for flax, and that's above your cost of production, then be a little more aggressive that way. But still, don't dump at all. But yeah, that would be my suggestion.
Okay, great. Thank you. So we're almost at the hour, so we'll wrap up for today. I want to give a big thank you to you, Chuck, for sharing such great information. Thanks to everyone in our audience for joining us, and we really appreciate that. Reminder that this is a first webinar in a four-part series. We hope that you'll join us for our next session, which will be looking at succession planning and tax strategies, which will be on December 2nd. We also have a number of other events coming up over the next few months. Check out our event page on our website for those, including grain grading training, leadership insight program, and as Chuck mentioned, our Crop Connect conference, which is in February in Winnipeg. Those who are really interested in this topic can come and hear more from Chuck for 3 hours on this topic. So with that, I want to thank everyone again, and we look forward to seeing you at our next event.